Hey everyone, welcome to the session of managing risk. So, here we'll be talking about risk and diversification, what it means, and why it's important to us. So, firstly, what is diversification? So, diversification, if we have on the right here, this is just a snippet from Investopedia. Again, I don't know if I mentioned previously in the course, but Investopedia is a fantastic resource for you to read about different financial terms online or strategies, or just to generally further educate yourself. I can highly recommend Investopedia when it comes to anything that you're not sure about. But here's just a snippet. If you go to the page on diversification and what it is. So, in short, they have it here described as owning a wide variety of investments with different characteristics to reduce volatility. So, what does that mean? Basically means no, simplified here on the left, no overexposure to one particular asset class by basically spreading out your investment so that instead of don't put all your eggs in one basket, that's exactly that, right? So you put it in multiple different baskets, have things spread out so that if one thing fails, the other ones are still okay, and the overall basket of performance continues to succeed. So it's the safest and most common form of risk management by instead spreading your exposure out to many different markets and businesses. So ideally things that are uncorrelated with each other. So like if a particular sector or company goes down, the other ones are unaffected. So to make sure that you have as low risk as possible via diversifying. So that's what it is and why we do it. Why should we manage risk through diversification? So pretty much what I talked about before, right? So if we have, for example, only buy one particular stock, this would be extremely volatile as a single news event or earnings report could massively increase or reduce the price. This is very risky. So basically, for example, if I were to dump all of my money right now into Apple, a great performing stock, things can go very well, but also a single news event, or if there's a scandal at the company, or suddenly, I don't know, a virus infects all of their phones or whatever, they have to do a recall of products, that would then completely collapse the share price. Same with any other company. Companies are individually very, very good, but individually also very risky. Companies collapse over time. Sometimes they do very, very well. Like Nvidia, the chip maker, over the last 2 years since the rise of AI has been doing extremely well. So things can go very strongly up or very strongly down. When you focus on a single company, while it could be very financially rewarding, it is extremely risky, and you can also just suddenly lose 30, 40, 50% of your money if it decides to collapse. So instead, if we go from a single stock to a set of stocks, so we only buy a set of stocks, but only from the tech industry, we will be a lot better off as our investment is spread across multiple companies, and thus the return, the price movements will be less volatile of the average companies that we buy. But since they are still positively correlated to each other, what does positive correlation mean? Means that when one thing goes up or down, another thing also tends to go up or down at the same time. It's everything's related to each other. So, in the case of tech companies, so if there's a general market sentiment shift for the whole sector, maybe the best comparison for this is the crypto space. So, as you may know, in 2020 and 2021, there was a huge craze around crypto and Bitcoin and Cardano and Ethereum and all the different cryptocurrencies that all of the businesses relating to crypto and crypto exchanges, anything related to crypto, they were all going together, but they were very, very hot. It was very, very expensive, and the price was skyrocketing. And then suddenly everyone sort of lost interest in the general crypto market as a whole. So in 2022, once the Ukraine crisis started, triggered a lot of sort of people to have a reality check, and that pretty much completely collapsed the crypto market in general. Even if your particular company or set of companies that you invested in were actually good companies and were performing very well, because of the whole sentiment shift for the entire sector, it experienced a big drop. So if you buy a particular set of stocks that are very correlated to each other, and the example here is the tech industry, but the same thing could be applied to oil and gas industries or the automotive industry as a whole, or maybe if you only buy a set of stocks relating to farming and agriculture, these things generally, when something affects one of them, it typically tends to also affect a lot of the others as well. So your portfolio will feel a very big drop or gain. So it's still better than buying a single stock in terms of risk, but since they're all correlated with each other, it's still somewhat risky. So a big factor of why we want to avoid such big swings by diversifying is that big swings and risk also make you a lot more stressed and emotional. So a lot of people then end up doing bad decisions when they suddenly see their portfolio as a whole drop massively by 10, 15, 20, 30%. And instead of holding on and just not giving in to just general market sentiment and mood shifts and mood swings, they end up selling instead of just holding onto it till the market becomes normal again and letting the company grow over the long term. So one reason why we want to sort of reduce volatility is to also reduce the pressure on ourselves, to make sure that we keep on going on with good decision making. And yeah, that's basically it. So how should we diversify is the next question that you're probably thinking of. So actually there is no 100% clear answer as to how exactly you should diversify, as this also depends on your personal risk tolerance and beliefs. So we don't mind some moderate risk if we're particularly confident in the future of, let's say, tech or oil and gas or AI companies or environmentally focused companies. So this is also known as ESG companies. ESG is short for environmental and social governance. So companies that are focused more forward in being environmentally conscious or socially conscious, what we can do is invest in ETFs on these particular sectors to spread out investments in the sectors that we believe in. And we can show you later on in the course how you can find an ETF for a particular sector that you're interested in. So yeah. Or if we want to diversify even more, instead of tracking a very particular sector, we can invest in an index fund, which is what we talked about before. So instead of investing in a particular sector of the economy or the sector of a market, we want to invest in the whole market of a particular geography or even the world. So like the S&P 500, so the Standard & Poor's index, or the top 500 companies in the US stock market. Or if we want to broaden even more, we can, instead of investing in the top companies of a particular country, we can invest in the world MSCI indexes to invest in the general global economy. So world MSCI is an index fund that tracks basically the global economy. There are different subversions of this, where it's, instead of world MSCI just global, there's also world MSCI emerging countries or emerging economies. So that's generally into developing countries, sometimes in Africa, sometimes in Asia. In eToro, we can also have a look at, for each index fund that we look at, what companies or what regions they're focused on. So there's a breakdown in eToro for that. And the best part is, as we go across these different levels of diversity and reducing our risk through diversification, our partner broker actually makes it super easy to make a portfolio that fits you and gives you a clear risk score, to give you an idea of what type of portfolio you're choosing and which one to choose that fits your risk tolerance. So, I mean, I'm sure you've heard that phrase before, high risk, high reward, low risk, low reward. It also comes hand in hand when it comes to investing. So if you're hoping to have a little bit more of a risky, but something with a lot of financial upside, you may be willing to tolerate a little bit higher of a risk. Elsewise, if you want to keep things relatively low risk and you want to go for reliable, consistent returns, our partner broker gives you a great risk score to understand on a scale of 0 to 10 how risky something is. So this is basically why a big tool in our diversification will be index funds, ETFs, smart portfolios, and copy trading in eToro. So explaining indexes and ETFs. So indexes are a pool of many different stocks. As mentioned before, you invest into all the assets with an index fund. Example is the S&P 500. An ETF is basically short for an exchange traded fund. It's very similar to an index, and often you would invest into an index via an ETF. So ETFs are a little bit more flexible, and they're also a little bit cheaper to buy than buying directly into an index. But ETFs, since they're more flexible, they're able to narrow in on particular sectors. And usually when you go to an ETF on eToro, you can look on it, the information on it, to see exactly what it's invested in. So you have a general idea of what the ETFs focuses on. But yeah, with our broker, they're effectively the same. So if we're buying an index, we're buying an ETF of that index usually. So let's have a look in the app actually. So here we're in our eToro demo account. We're currently in the virtual mode, where we have a virtual portfolio of 100,000 that we're given. You can switch to real mode at any time, but if you're in here in the real version, make sure to switch to virtual for our practice sessions now. So, okay, how would I look for an index? Where you can go to here is Discover, the Discover section, and you can have here the little dashboard. You will have seen this before. So if we want to go for a particular index, we can go to Indices. They have a few indexes here. So, the JPN 225 is the Japanese market, the UK 100 index for the UK, same with Germany. Here we've got the NASDAQ and the S&P 500 for the US. So we have a couple of indexes here. So this is if you buy directly into an index. But what you can also do is, instead of indexes, you can go for the ETFs of those indices. So for example, the S&P 500. We also have alternative ETFs of, let's say, the Vanguard S&P 500 ETF, the SPDR S&P 500 ETF. They're pretty much all tracking the same thing, right? So, I mean, you can probably see identically here, the recent changes is pretty much identical. It's just a slightly different way of purchasing and tracking the same market. So don't worry too much about that. So yeah, let's go into an example of, let's say, buying directly an index of the S&P 500. Let's go into here. And if we wanted to buy it, first of all, we can look at the performance here. So performance over the last week, 6 months, 1 year, 3 years, the maximum time period that they allow. Here you can see it's been having a little bit of a dip over the last few years, and then it's went up again. If we go into the max horizon, we can see that it's always been steadily increasing over time. So S&P 500, usually a great buy to then hold over the long term. You can look at the charts, the news. The news section is only available once you actually go to the real version and deposit your first amount of money. This account, we've just used it for a demo, so we don't have any money deposited into this account. But you would have access to news here. So anyways, if we wanted to buy this, we would click trade. Make sure, please, to always use 1 times leverage. So, and we set that to 1 times. Basically, a reminder, what is leverage? It pretty much allows you to trade on margin using a lot of debt. So for example, if I were to invest 10,000 without any debt, the most I can lose is 10,000. And if I were to, let's say, double my money, I would overall gain 20,000 back. Or if it triples, I get 30,000. Whereas if I use leverage, so if I use 10 times leverage, it basically buys this amount plus an additional 90,000 in terms of levered or debt money that we use. So that if, for example, if things go badly, if the index dips 10% in value, we would immediately lose this 10,000 in value. So if it dips 10%, it would, instead of it being 10% of 10,000, which is 1,000, we wouldn't be losing 1,000, but we would be losing 10% of 100,000 exposure, which means I'll be losing 10,000 in one go, and I'll pretty much lose all of my money. It also works the same in reverse. So if it increases, if this price of 10,000 that we buy into, if it increases by 10%, we would actually gain not $1,000 in worth, but $10,000 in worth. So it pretty much magnifies everything that we do. And since we're in the business of making sure that we're staying as risk averse as possible, let's just always not use leverage, and let's just always set it to 1 times. Here you can set a take profit or stop loss. This means once the value of my investment goes up to 15,000, it immediately sells the index. If it suddenly decreases to 5,000, it immediately stops and sells the index again. It pretty much limits how much you can lose or take. You can set this according to yourself, but especially if you're buying individual stocks, you can take the decision for yourself whether to take profit or stop loss. I personally set my take profits or stop loss a little bit higher, especially since I'm intending to have this for the long term. So I would actually set no take profit because I want to hold this for a couple of years. Stop loss, I can maybe set it to 5,000, but the reason why I don't want a stop loss that's too close to the original amount is because if the market suddenly decides to have a bad day and things go down, I don't want to suddenly be automatically sold out of my position. I want to buy and hold for the long term. So actually in this case, I would also set no stop loss. If the market decides to suddenly have a crazy day and go down by 40, 30% or 50, 60%, I know that I'm in it for the long term, especially when it comes to indexes. So I would then click buy. I would set it to market order. And then I have a order received, order filled. So I bought now $10,000 worth of the S&P 500. I can go into my portfolio. I can always check that. So yeah, here you go. I've gotten this amount. It's gone down by a few percentage points. Now it's gone up. So yeah, this will then basically be it. Regarding the stop losses that I mentioned previously, if you're buying individual stocks, then it definitely makes sense to create a stop loss or a take profit limit, because since stocks are very volatile, you don't necessarily want to, if it suddenly increases by 50%, probably the market's a little bit crazy and you want to take the profit where you can in case it's overpriced or whatever. So with individual, more risky investments, it makes sense to do a take profit or a stop loss. Elsewise, for index purchasing, at least, we don't really want to have a stop loss or take profit because we're in it for the long term. Okay, so explaining smart portfolios and copy trading. So, smart portfolios are basically pre-constructed portfolios designed by the biggest institutional investors out there, like BlackRock and Vanguard. So they give clear information on what type of portfolio they have that is pre-constructed for you, what they're invested in, their historical returns, risk scores, and type of investor that they're designed for. So it's a fantastic way to actually have a whole portfolio. Just a reminder of what a portfolio is. A portfolio is a collection of stocks or indexes or just a general group of things that you're invested in. That's a portfolio. To have a portfolio constructed for you so that you can choose from, so that you don't have to do any research yourself directly or have to go out and individually buy indexes of different regions and stocks of different regions yourself. You can just go for a smart portfolio. Alternatively, you can also do copy trading, where you literally copy the trades and portfolios of individual investors out there that you like. So let's have a look in the app now to see how to get index and ETFs we already covered. But let's now look at smart portfolios and copy trading for ourselves. So let's go back into the app. So we had our index that we already bought. Let's go into Discover. Indices, this section we already bought previously. We also know about ETFs, where these are the ones going into the S&P 500. This is the MSCI India, so basically tracking the Indian economy. This is tracking gold, this is tracking silver, this is tracking treasury bonds. So you have a lot of different things that you can choose from when it comes to ETFs that track a general sector. For example, this is just generally tracking the energy sector. So you can always look at the description about a particular ETF. And now let's go on to copy trading. So we'll look at that first. So yeah, here it briefly says when they invest, you invest. So you can use Copy Trader to copy the moves of other investors, find users that match your investment plan, and diversify with a click. So you can look at different trending investors, their returns over the last 2 years. So these people have been going particularly well. We could, most copied, what their returns are like. Let's just look at an example of some of the trending ones. So let's see here, Lin Liu. You can look at him. Yeah, engineer and venture capitalist with 10 plus years of investing experience. So this is actually someone who's a little bit similar to my background. So he's used to a lot of tech startups, has probably a little bit of a very forward-looking view on the world when it comes to technology development. You can see here his performance across time. Overall, been doing very strong performance over the last 2 years, at least. Obviously, a huge dip in 2022, but I think most people would have that since in 2022 we had the crash ever since the Ukraine crisis started. So a lot of people investing in tech or in any stock sort of across the world would have experienced a huge dip. Well, here he doesn't go too much into his portfolio strategy. You can basically see all the posts here that he's written about, so you can get to know him. So you can also, it suggests here similar traders. So let's look at Joseph Greenwood. Yeah, you can look at their performance in previous years, what they're posting. You can look at in-depth statistics of their overall portfolio movement over time. So green representing positive shifts, representing negative shifts. Yeah, you can look exactly into their portfolio of what it exactly is they're holding. So, he's invested in General Motors, he's invested in StoneCo, Royal Caribbean Cruises. So you can see exactly what they're invested in. And here you have a chart of movements of their portfolio. And what you can do is you can either add it to your watch list, where you can pick and choose the different ones that you like the most. And then you can go to your watch list later on, or you should find them here. So you can filter for people and see different people that you've watch listed. And what you can do is then ultimately, if you want to copy them, you can click the big green copy button. First copy trade. Okay, got it. And you can choose the amount that you want to copy with them. So let's say I invest let's just set this to $500 that I want to invest with them. We can close an investment if it drops below $25. Yeah, let's set this to maybe, I don't know, let's set it to 200. So if it drops below 41% of value, I'll know that his portfolio is doing really poorly, or even to a 55, in which case I would just want to close my investment. You can also set this to an exact percentage. So I'll just go to 50%. You can choose the exact stop loss that you want for yourself automatically according to what your preference is. I'll just set it to 50%. I can click invest, and I am basically now copying his moves with $500. So those $500 will purchase exactly the portfolio that he's bought into, and anytime he makes a change, I will accordingly also make automatic changes for me in my portfolio. So that was copy trading. Now let's move on to smart portfolios. So copy trading, a great way to diversify or take the legwork of investing and trading off you, so that you can have someone else take it over if you like them. Elsewise, smart portfolios is a great option. So these are portfolios designed by large institutional investors, where they have here pretty much almost a description of the type of portfolio it is. So we have core stability. So for people who want to go really, really safe and want a lower return, people who want a little bit of risk, maybe investing less into, let's say, bonds or treasury bills, but a little bit more into the stock market, core dynamic, even more into equities. So let's, for example, click here into core moderate. So let's maybe not do core moderate, say core dynamic. Oh, seems not available in my country. Okay, seems I cannot invest in this directly. Could be that in Spain, where I'm from right now, it's not available. That's unfortunate. Okay, so it could be that it's not available in exactly where I'm going from right now in Spain, but it could be available in your particular country, in which case there would also be a buy button here. But just to explain what this is and what this does. Okay, so show full bio. Introducing core equity, crafted for investors with an assertive approach to capital growth. This portfolio is dedicated to those with a high risk tolerance seeking to maximize long-term returns through a focused equity strategy. So this highlights that it's equity driven. It's an assertive approach to focus on particular markets and sectors. So for investors that are a little bit more ambitious, and you can see here, even to date, they already experienced 10% returns, which is very high. And even though it's very deemed as high risk, it's still on the risk scale. So this risk score you should be able to see on everyone. The risk tolerance here. So this is deemed as not the safest, as a little bit more risk, but overall the volatility is around 2% over the last 7 days. So overall, it's been acting relatively stable. It's not too crazy or anything. You can go into their portfolio. You can see exactly what they're invested in. So they're typically invested across different ETFs. These ones, so core MSCI emerging markets, MSCI USA, so tracking the US market, the Canadian market, Chinese market. So they're generally invested across the different stocks of the top companies in very particular regions. So it's quite broad, but it's still very equity and stock driven in comparison to, let's say, investing in bonds. So if we go here to core stability, if we go into the portfolio here, we can see here, yeah, they invested a lot into mortgage-backed securities. So in real estate, they're investing a lot into bonds. So just as a reminder, what are bonds? Bonds are basically debt that you give to government. So in this case, you would lend money to the government and they pay you a certain interest, a fixed interest rate called a coupon. Pretty much you lend money to the government. And actually the US Treasury bond, since the US is seen as the most financially stable government in the world, it's basically seen as the most risk-free investment possible. So we don't expect the US government to ever default on its debt. So that's basically what the core stability portfolio invests in. So a lot of bonds, a lot of very, very safe and risk-free investments. That's why obviously the returns are a little bit lower, since it's lower risk. It also gets lower returns. And you can see here they're invested in JP Morgan, again, US aggregate bonds, corporate bonds, treasury bonds. So it's a lot more bond focused. And if we look at the stats here, we can see exactly how it's performing. What else? I think that's basically all there is to say about smart portfolios. So these are the core portfolios. They also have here, even a new collection here of how to allocate capital to the top Italian companies with the Italian Heritage Smart Portfolio. So here we can actually invest. I guess since it's Italian, it's within the EU, and since this account is based in Spain, we can invest in it. And we can see here the historical returns of the top Italian companies. You can see the news related to it. You can also see the statistics of performance, the portfolio. Again, anytime you go into a smart portfolio, just go straight into the portfolio section here. And you can see exactly where they're invested in. So, for example, they're invested long-term into Ferrari, Pirelli, Moncler, Fineco Bank. So the top Italian companies, Banco BPM. Yeah, basically that's what smart portfolio is. So portfolios that are already constructed to fit you, focused on a particular sector. So you can see their newest collections, their tech-focused collections, so focusing on only fintechs, Bitcoin worldwide. So this is probably a great way to invest in a particular sector of focus that you're interested in without having to do it yourself. Here, you can see this is a great section. This is actually investing to copy certain big investors or sometimes political players. So, okay, one of the Edgar Wachenheim is one of the world's top value investors. Invest alongside with him. You can click onto him. You can understand his performance, and I see here he's generally been having very strong performance over the last years. Return to date is already 15%. It's very strong. We can see into his portfolio, and at any point we can then click invest. Let's say I'm very bullish on him, so I'll want to invest, let's say $5,000 with him. Invest. It's basically as simple as it goes. You would invest to then copy exactly this portfolio that he's invested in. So he's invested into a lot of Lennar Corp, Citigroup, which is an investment bank, JP Morgan. So he's pretty much very strong at Goldman Sachs. He's very strong into, let's say, electronics, banking, etc. If we go back, I wonder if we can find maybe a different person. Bill Ackman. He is one of the most famous activist investors in the world. What does activist means? He when he invests into a company or a sector, he takes a lot of action to personally influence and improve a company's performance. So he's very aggressive in that sense. He's a very loud voice. A lot of people like him. Some people don't like him. I personally am a strong fan of what he's done. He's a little bit crazy, but he's a strong personality, and I guess that happens with strong personalities. You can always see into his portfolios and what he's invested in. So I see here is big on Alphabet, so Google, the Hilton chain, etc. So this is pretty much smart portfolios at the bottom section looks into their public filings of what they're invested in and tries to copy them. We can always click on view all whenever we want to look at a particular thing. So yeah, here they're still building out the smart portfolios, so there's not that many smart portfolios there, but you can always look into what's interesting. So if I want to invest purely in advertising or the Latin American economies, smart portfolios are a great way to sort of invest into a portfolio that fits you in terms of interests as in sectors and risk, and we can see exactly what level of risk each one of these has and how many investors are alongside it. So it's a great way to sort of see what's going on. All right, now I think that's it. Let's go back into the presentation. So picking by diversified assets, what should we do? In the end, don't have an overexposure to any one particular asset. As discussed before, it's best to go broad. Either make a diverse portfolio for yourself or use a pre-made smart portfolio yourself or copy trade someone else. If you have a strong belief in a stock, which is the case if you're a true believer in, let's say, Netflix or Facebook, the parent company of Facebook, Meta, or Google, Alphabet, Microsoft, etc., or OpenAI if it ever becomes public. Although since they're acquired by Microsoft, you can pretty much invest indirectly via Microsoft. Anyways, whatever stock or company that you're really true believer in, that you think they will do very well long term, that's fine. But try not to let a single stock represent more than 10% of your portfolio for the reason of diversification and risk management. And if you have a very strong belief in a sector as a whole, don't let a sector ETF represent more than 33% of your portfolio if you can. You may start to be interested in bonds if you want a super low risk and low return investment, but this is not super recommended unless you're really close to retirement and want to play it safe. If you're in your 20s, in your 30s, in your 40s, you're still quite young, or even your 50s, you're still relatively young. I think here I'll be focused a little bit less on going super, super safe with your risk and volatility, since, you're still investing for the very, very long term. So instead of investing in bonds, I would invest in companies or equity markets instead. Obviously, this is not an investment recommendation. This is purely educational and my personal take. You're responsible for your own investment decision. I think that was the last slide, and I think we're now done with managing risk. I hope that has helped. The next module will be going into setting our strategy, so see you in the next video.